We got a fresh reading today of the cost of living here in Canada. The inflation rate rose to 1.9% in August, picking up from the 1.7% rate in July. An increase widely expected, but slightly lower than what some economists had expected. So could it pave the way for an interest rate cut? Well, the current rate sits at 2.75% and hasn't shifted since March. The Bank of Canada will reveal its latest decision tomorrow. Now, it all comes as the Liberal government tells Canadians to expect a substantial deficit in the upcoming fall budget. So where does all of that leave the state of the economy? Armine Yalnizyan is an economist and Atkinson Fellow on the future of workers, and Jimmy Jean is the chief economist and strategist at Desjardins, and they join me now. It's good to see you both. Armine, I'm old enough to remember when we pined for a 1.9% interest rate, because like 3 years ago it was 7% at this time. Does this surprise you? What do you make of this upward tick? Should Canadians be worried?
Look, we haven't hit the road bump that is the tariff-induced supply shock. We may never hit it. I can't believe that we're not going to hit it. But it hasn't arrived yet. People have stockpiled and front-end loaded their activities to make sure that we didn't pay more. And so, yeah, we're sitting pretty, especially since after they axed the tax in April, gas prices came down quite a bit, by about 10 cents a liter. And so, you know, that is still playing through month after month. And gas has been the most volatile part of inflation. But just a gentle reminder that grocery prices still are going up higher than headline inflation. Yep. And one of the biggest consistent rises are rents. And even if they cut the interest rate tomorrow, that will affect mortgage rates that are coming due for refinancing, but it won't really do much for the people living in rental apartments. Right.
If you rent and spend your money on rent and groceries, you're at the bottom of the economic ladder. Your real inflation rate is higher than headline inflation because it's what you spend your cash on. But Jimmy, when you look at that and the uncertainty over where tariff pain is going to hit and when, I mean, what do you think this does for the Bank of Canada's decision that it will reveal tomorrow?
Well, I think the Bank of Canada has the green light to cut rates. That's what most forecasters are expecting. That's what the market participants are also expecting, not just because of this report that was, I think they will see it as reassuring, but also what you're seeing developing on the job market, where you've had 100,000 job losses in the span of only 2 months, and pretty broad-based across sectors. So not just the sectors that are directly affected by the tariffs. I think that's an important input that the Bank of Canada will be taking on board and making that decision. But as it relates to the inflation numbers this morning, as you mentioned, we're still below target. The increase was expected, but it was a smaller increase than what was anticipated. And when we drill down and we look at the data, we see signs. For example, the 3-month annualized core goods components, that's rising at only 0.7%. The prior month it was above 2%. Same thing when you look at core services, it's at 1.7%. It was nearly 2.5% the month before. So you have some signs in there that things are going in the right direction. And also we know that in August, those counter tariffs were relaxed. So that will also help alleviate pressures going forward.
Right, but Armine, I mean, can you take an optimistic outlook, on the short to medium term on inflation, on interest rates, with everything that is happening with the job losses? Jimmy pointed out, I mean, manufacturing is getting hammered. I mean, can you be optimistic even if core goods are going in the right direction?
I think if the bank is cutting rates right now, they're not optimistic. What they're reading is we need to take out an insurance policy to minimize that kind of bleed in the job market and in the productive activities, and potentially to save some of the business ecosystem that has been relying on borrowing to get through this, and it's just getting super expensive. So we always talk about mortgages because that's what we do. But the bank has to worry about how the entire economic system is working. And I think if we cut rates, it's a sign that they don't think it's going in a very good direction, because they usually cut rates more than once and done, one and done. They usually, there's a little flock of cuts coming. We're already much lower than the United States. And as I said earlier, I think though we have lifted the tariff, a good deal of the retaliatory tariffs, we still have tariffs in place. And we are paying more for things. And people have done everything they can to try and buy time before, it's just to see what's going to happen. And what's going to happen is we're going to have a supply shock one way or another. And that's what happened after the pandemic reopening, where we just didn't have enough stuff and the prices of what we had went up. And I think we're beginning to see that in some goods, notwithstanding what Jimmy just said, which is correct. And, you know, it will be very difficult for the bank then to reverse course. That's
Right.
not what we want. When the only team that's in town whose one job is price stability suddenly looks like we don't know whether we should hike rates or drop rates. And that's the struggle they have. They have one bucket of water and they got two fires in two rooms. Which room are they going to go to first? The one where jobs are burning, or the one where prices are going up in smoke?
Right, and that stockpiling you mentioned earlier, a lot of U.S. manufacturers bought up a lot of raw materials and components they need to get ahead of Trump's tariffs, and those inventories, you know, might last into the first quarter of next year, but we'll see then, right? Some of them could already be gone, and that's when you get the supply shocks. So Jimmy, in this context comes the first full budget in 506 days, the first budget of Prime Minister Mark Carney's administration and Minister Champagne's first budget as finance minister. They're talking about a substantial deficit, bigger than last year, which was about $50 billion, you know, give or take, depending on what you include in there. I mean, what do you expect to see there, and what kind of a jolt does that have on things domestically?
Well, I think it's only going to be reflecting what we've already seen being announced by way of just meeting the 2% target this year. The tax cuts that were announced earlier in the year, the consumer carbon tax removal. So all those elements that were already announced will be reflected in that bottom line. On top of that, you have an economy that is obviously struggling. We had a contraction in the second quarter, and the second half of the year is expected to be sluggish. So certainly significant departures from the last document we have on hand, which was the fall economic statement of last year. So expectations and forecasts have evolved quite a bit and to the downside. So that will hit the top line in terms of revenue. So I think there's going to be a lot of that, a lot of the initiatives as it relates to building housing, elements on defense, and so it's been a very activist government, very bold announcements. I think what we're looking for at this point is really how we're going to at least mitigate the impact. And they've talked about 15%. Program spending cuts over the course of the next 3 years. But the question is how they're going to do that without cutting jobs within the public service. They're saying that they want to do it through attrition, but that might be a tall order to do without resorting to job cuts. And if they do resort to job cuts, then it will add further downward pressures on the economy. So it's going to be a difficult balancing act, I think.
Yeah, the Public Service Alliance of Canada, we've got a conversation with them coming up on the show. They already say about 10,000 jobs have been eliminated through the ending of contracts and term employment and these sorts of things. So even beyond attrition, there is some change there. But, Armine, we've heard numbers like $100 billion deficit, $80 billion deficit, stuff that outside of COVID times seems unimaginable. What's your expectations for the budget and what impact it might have?
Well, to Jimmy's point, we have $59.4 billion in tax cuts that have been promised to us that will emerge over the next 5 years. Plus, we are going to double. We found $9.3 billion extra cash in the couch cushions for defense spending this year. So the real tell this year is going to be how, if we're going to go into a deficit, it's going to be a military spending deficit and an own goal, right? We shot ourselves in the foot on cutting revenues at a time when we need to spend more because of everything that's happening. And so the big thing to watch for is how are they going to use the defense money? How will the defense money get used in the sense that is this military Keynesianism going to create employment and infrastructure in Canada? Or are we going to be buying new alliances with Europe and the UK to protect ourselves from crazy pants in the United States? As for the job cuts or the efficiencies that they're talking about finding, whether it's through attrition or through cuts,
Right.
don't forget we are talking about the denominator keeps getting smaller. First of all, we're going to separate out operating and capital. We don't know in what tighter capital and operating budget should happen. I think it's a great idea, actually. And then in operating, we've been told, oh, we're going to ring fence transfers to provinces. We're going to ring fence transfers to individuals. And
Right.
oh, we're not going to cut health or childcare or pharmacare. So like the denominator is getting smaller and smaller. It might be easier to achieve than you think.
Well, you might be right. I mean, a shrinking economy does help you get to 2%. Jimmy, I've got 30 seconds left. It does sound like they are looking at defense spending as a core part of industrial policy, economic growth, and building out the North. Is that what you expect to see on that stuff?
Right. This is really when we're talking about infrastructure, and particularly dual infrastructure, so infrastructure that can help with getting access to critical minerals and develop the necessary routes to export those minerals to global markets, but also that can serve in terms of assisting with military operations or implanting military infrastructure, let's say in the Arctic. So I think that's all part of the plan. But the devil's going to be in the details as well on that front, because we know that when it comes to procurement, and we look at the track record of the last 10, 15 years, it's not been pretty in terms of execution. And, you find that a lot of those ambitions, since Carney's been in place, rely on pristine execution. And we don't have any guideposts, any sign that this will be achieved and that Carney will succeed where his predecessors have failed.
Pristine execution is a phrase I'm going to steal from you, Jimmy Jean. I appreciate that, and I appreciate your time. You and Armine Yalnizyan, always a pleasure to have you on. Thanks for being here again.